Me?
I can hear you perfectly. There's a little bit of an echo, but we'll work through it.
Okay, great.
Wonderful. Callum, please introduce us to yourself for the stream and let us know about Winefi.
Yeah, sure. So, hi, I'm Callum Woodcock. I'm the CEO and founder of Winefi. Winefi is a multi-award-winning next-generation platform for investing in fine wine. Our ambition is to make it so seamless and cost-effective that fine wine can feasibly form a part of every portfolio for the very first time. We do that, one, through ease of access. You can invest in wine through Winefi in just a couple of clicks, but also by really lowering the barrier to entry to invest in wine. So we've developed this unique syndicate structure that allows people to gain exposure to an expertly curated, diversified portfolio of fine wine from as little as £3,000. So really a fraction of the cost of owning the underlying wine outright. And I've actually got, if I look slightly underdressed, I am. I'm in rural France at the moment, and it's boiling outside. However, I have got the Winefi logo, so
We love it.
Good.
We've got to get some of the wine on the show. We'll have it in the background.
Yes, yeah, we absolutely should. Yeah, we should do a live tasting.
Oh, that would be absolutely. We've got to make that happen. Callum, talk to me about the syndicate structure. I find it incredibly interesting. And we had David from the Car Crowd on the show. Is it a similar model?
It is a very similar model. So I know David very well. He's been a huge sort of advocate for our business, and we speak often. Effectively, it allows multiple different an asset. So the structure itself is a UK Bear Trust nominee. That's important because it allows syndicate members to hold the wine directly themselves. So the syndicate owns the wine rather than Winefi, which is really, really key. Not only because, in the event that Winefi was to cease trading, the wine would remain the property of syndicate members, but also because they are holding it directly. And there is no difference, therefore, in terms of how the wine is treated than if they actually own those bottles outright themselves. And that's really relevant in wine because in many cases in the UK, fine wine is exempt from capital gains tax. And by holding the wine directly through this syndicate structure, the CGT benefits still carry through to the end investor, just as if they own the portfolio outright. So effectively, it isn't a fund. Syndicate members have far greater rights than an investor in a fund would. They really maintain day-to-day control of the assets, but it does allow us to reduce that cost of entry and bring multiple investors together in order to invest together.
How do we think about wine when it comes to investing?
Sure. So I think it's a really interesting one, and it really stood out for me really against other collectibles in that it has a lot of the characteristics of a more mainstream, more traditional asset class. I think in terms of performance, which is what your audience would likely care about the most, wine has historically delivered equity-like returns. It is, as I mentioned, exempt from capital gains tax, and a really attractive factor, especially for more sophisticated investors, is that it displays a very, very low correlation to traditional asset classes like equities, bonds, commodities. So it's a great diversifier within a portfolio. On the downside, it is ironically relatively illiquid, so it can take time to sell down a large portfolio of wine. And that's really why we only stick to wines where there is significant and proven secondary market demand. So because wine pays no yield, the only way to make money investing in wine is to sell that wine onto someone for more than you purchased it for yourself. So secondary market liquidity is really key. And yeah, I think the fact that really does make it unique compared to other collectibles is the fact that there is 25 years now of real-time trading data. So you can see how certain wines from certain producers have been traded in the past. And that's really unique because you don't have that in whiskey or watches or I won't say classic cars because I don't want to annoy David, but you're very reliant on auction data as opposed to real-time trading data. And obviously art in particular, a painting is one of one. So it's not the same. You're unable really to compare apples to apples when you're comparing two paintings. And I found that fascinating because it means that you can train data models on that historic data with the objective of trying to predict and thereby outperform the wine market. And that is exactly what we've built. I can't take too much credit for our data models. It should all go to our head of data, Aaron Daniel, and our data scientist, Raf. But effectively, we've built a model that allows us to identify wines that have the highest likelihood of outperforming the wine markets based on that historic price movement. And so far, we've generated really significant alpha versus the market benchmark, so the LiveX indices, for example.
Echo in my ears.
No worries.
I think it's me.
I could connect my, I've actually just noticed my AirPods have disconnected, which could be the reason why. So I've just connected them. Is that any better? Any better? It's the joys of doing it live, eh? I can hear you. Yeah, I can hear you perfectly. I can, yes. Are we still live though? Okay. Yeah. Yes. Yeah. Yeah, it's a great question. So there are a number of different factors that come into our model. So each
Wonderful.
of our,
Callum, please introduce us to yourself.
Variables that we look at across 100,000 wines and I think a total of 80 million data points. So it's a relatively large subset of the the total fine wine market. It's really unique. Really, what we look is to incorporate anything that may change past performance and then run back tests. So, for example, critic scores is a very obvious one. How has a certain wine or a certain producer historically been scored by various different critics? And what we've found, and this won't come as a surprise to anyone who really knows their wine, is different critics act as market movers in different regions. So Robert Parker, who's a very famous American critic, now retired, was seen as like the authority in Bordeaux and Napa, whereas there are different critics for different regions. A specialist in Tuscany or Piedmont, for example, would be very different to one who specialises in Burgundy. And all of those rescores, therefore, have to be weighted a certain way when we are, looking to identify the best possible model to identify wines most likely to outperform the market. But in terms of the actual asset selection process, so we really have two models. The first model will look at those factors and score the wines based on what we term a WIS, a Winefi investment score. 0 being don't touch this with a barge pole, 100 being like this is all the characteristics of a great investment grade wine. Yeah, there's many wines that sit within that that bracket. I mean, less than 1% really of the total wine market is investment grade. So you can have fine wine, which is obviously on the higher end of the scale in terms of quality, but investment grade is another level. So it's a very, very small subset. But the really important thing when you are looking to invest in wine is the entry price. If you have massively overpaid for a bottle, it doesn't mean, it doesn't make a difference how investment worthy that particular bottle is. It's like, buying a house at twice the asking price. You'll struggle to make money on it. And so we have a second model that basically shows our target purchase price for that particular wine. And actually where, I do think the syndicate structure has really given us an advantage is because we raise funds in advance from investors for a strategy and then deploy those funds, we're able to go to suppliers and say, we have £500,000, to deploy into Italian wine, just sort of making it up. Are we able to get a bit of a bulk discount here? And many merchants, many wholesalers, many intermediaries, and especially many private clients that are looking for liquidity are willing to do that. So it's turned out to be a relatively effective way of buying well at scale. Yeah. Yeah. Absolutely. So we can obviously run tests from how would returns have looked had we invested on the 1st of January 2010, and we can run them over multiple different time horizons. So typically we look at 4 years because our syndicates run for 5, and we want to give ourselves some leeway there. But yeah, sure. Yeah. No, I imagine, and I don't want to speak for David again, but I imagine it's the same reason that we have, which is in order for this structure to work, it needs to be, you can't unilaterally withdraw from a syndicate, because the only way of furnishing that redemption would be to sell down the underlying wines in a kind of fire sale manner, which would harm the other syndicate members. So while syndicate members can vote to disband the syndicate, you can't unilaterally withdraw. And as a result, no one likes their capital being locked up for an abnormally long time. And 5 years from the surveys that we did was the time that people were most comfortable, in the time horizon that people were most comfortable investing in we're not a closed-ended product because we're not a fund, but in something where you cannot unilaterally withdraw. So I imagine that will have also factored into David's thinking, the actual appetite that investors have for locking up their capital. Although, of course, in our case, we are selling down the wines over time, so they are receiving payouts over the lifetime of the syndicate. But we basically say the anticipated holding period is 5 years. Yeah, I think so. I think there's a really interesting, kind of paradigm in the wine trade, in that historically decisions have really been made based on pattern matching and past experience from someone who is, they've spent 30 years in the trade, probably wearing red trousers. They know their stuff, but they know it intuitively. Whereas I think for us, we are super, super data driven. We're the only sort of quantitative wine investment firm out there. And really, we talk about it internally like Moneyball for wine. We spot patterns in the data in a way that no one else has before. And so we've leaned very, very heavily into being the market leader on that front. And the models continue to improve. I think we've spent an enormous amount on different data sources, and we continue to do so. And the reason that we do that is because ultimately what people are buying with us is, exposure to the wine markets, but also the chance of outperforming the market benchmark, so outperforming the market average, in the same way that if you were to invest in an actively managed, fund focusing on Asian equities, you'd be wanting to outperform, the Asian equity market more generally, and generate alpha versus the relevant benchmark. So that's exactly what we're trying to achieve here, and that's why we started with data rather than sales. I am absolutely Brad Pitt. Yeah, I will happily take that compliment. But yeah, I think, yeah, I think there are some quite interesting parallels as well, because obviously we have people on the team who are extremely knowledgeable about wine. We have an investment committee of people that are very knowledgeable about wine. But our data team, neither of them came from wine trade backgrounds prior. And our head of data in particular has since very much fallen in love with the underlying asset, so with wine itself. But it kind of goes to show that actually approaching, like as in Moneyball, approaching an asset class through a data-driven lens, you don't necessarily need those decades of expertise in that particular space. That said, we do have our head of investment and our investment committee who always provide like a qualitative overlay, and that's really helped us kind of optimize the model and spot holes in it. It's never going to be 100% perfect, so it's important that we have a human in the loop. But it gets us a lot of the way there, and it saves us an enormous amount of time when it comes to the analysis of the broader wine market. Yeah, sure. It's a great question. The first thing I'd say is it's actually a myth that Gen Z is drinking less. They actually spend a higher percentage of their income on alcohol than any other generation at the moment in the market. There was a dip which frightened everyone, but that coincided, I think, unsurprisingly, with lockdown. And Gen Z effectively missed the going to uni stage, the going to party stage because of lockdown, and that really panicked, the wider kind of drinks market, I suppose. But actually, we're seeing a decline in alcohol consumption, which is happening globally, being driven by none other than the very boomers who are complaining that younger generations are drinking less. And they're drinking less because they're getting older. And this has been published extensively now in the in the Financial Times most recently. There's a wine writer called Sarah Denise who's spoken about this. And whilst I do think that fine wine, there's no doubt that the audience is older, it's not going to be anywhere near, I think, the kind of catastrophic sea change that anyone is expecting. You've got to remember that wine has been consumed for 6,000 years. It's not suddenly going to drop off a cliff. What I do think will happen and evolve over time is people's tastes. So, Bordeaux, in the 80s and 90s, it's big, it's full-bodied. It's great if you're having kind of like lamb for lunch all the time. People don't really eat like that anymore. And as a result, tastes have changed. We've seen the rise of lighter wines, so the Burgundian wines very famously. And I think that will continue to happen. And the really interesting thing from my perspective, when you look at past trends, is Bordeaux for many years was the only region that you could invest in. It was basically the only region with a secondary market of any note. It still makes up about 40% of the global secondary market, but it's really fallen in popularity as an investment. But what happened was essentially prices rose, fueled by demand coming out of Asia. So very famously, China prior to the gift-giving ban. They were driving up the prices of Bordeaux wines, and merchants and the chateaux themselves were more than happy to play that game. But what happened is that people who weren't prepared to spend 6K on a case of wine started looking to get their sort of Cabernet Sauvignon fix, which is kind of one of the dominant grape varieties in Bordeaux elsewhere. And that led to the emergence of like the Super Tuscans and Tuscany as a really popular region for people that wanted to go and, drink a Cabernet Sauvignon. And what's happened, ironically, is now Tuscany's become an investment grade region, and those prices are being driven up because the circle of life continues. And therefore, I would imagine that people that have been priced out of the kind of super Tuscans that they like drinking, you start looking at Argentina, you start looking at other regions, Chile, to get a great quality wine that you could drink, but at a fraction of the cost, that you would typically pay. And I think that's where, the real line between investors and collectors on one side and then the actual drinkers starts to form, because I've obviously got a wine portfolio. Would I dream of opening some of those bottles? I mean, I certainly dream of it, but I could never bring myself to open something that I have earmarked as an investment. I'm looking to hold purely for financial gain. But at the same time, I love wine, I love drinking wine, but I would always try and choose basically the cheapest version of something that I really enjoyed. If I can find a €7 bottle of wine in a French supermarket that really fits my palate, perfect for me. And I think that's really where the there can be the sense where I don't think wine is going anywhere. I do think that tastes will evolve, and as a result, what is currently investment grade wine, and we're talking over the long term, well beyond the length of a Winefi syndicate. But I do think that the wines that we're investing in today will be different to the ones that we're investing in 10 years' time, for example, because prices will change. Yeah, definitely. So the first thing is around secondary market liquidity. So if it's not being traded at any meaningful scale on the secondary market, we would avoid it, because we would risk tying our clients' money up in an asset that we might not be able to sell. I think lots of people talk about Spain as being an investment grade region, and there are certainly some existing investment grade wines from Spain. So Vega Sicilia and Pingus being two examples. But I'm really excited by South Africa. And I'm excited by South Africa because it's still very cheap to buy South African wine, but it has developed this absolute cult following. And there's a certain producer called Sadi, whose two flagship wines are Columnella and Palladius. And people are buying them directly from the producer and then flipping them on BBX, which is Berry Brothers' sort of peer-to-peer trading platform, for like 3x, 4x, 5x the price overnight. To the point where the winemaker has actually sent out, quite a waspy message saying, I've got no interest in becoming the new Burgundy, or, soon the new Piedmont. I just want to basically create great wines. But if people keep kind of, price gouging my wines, I am going to have to up prices. And I think that, that shows the kind of conflict that there is between, people who see themselves almost as artists in terms of crafting this amazing stuff, which of course people really want. And then those people who are, buying a case and then paying for that case by selling on another case of the same wine. So I think I could definitely see South Africa, becoming another, investment grade region. And actually, I love the fact that it's consumer led. The fact that it's individuals doing it, and it's the individuals that have discovered this winemaker rather than the merchants. I think is a really good sign because it feels much more grassroots. Yeah, yeah, lovely. Oh, love an Albarino. Yeah, peach, very nice. Yeah, great. Yeah, yeah, yeah. Great, both great questions. So we had a bit of an issue around how to price our syndicates. The original vision for Winefi was much more sort of fractional investment. So basically trying to lower the cost of entry to ideally like a unit. The issue with that was twofold. One, it raised eyebrows from a regulatory perspective because you were effectively saying, anyone can afford 50 quid and not everyone should be investing in wine. Um, but also, and this is, to be honest, the main factor for us, was it's very difficult to acquire a customer in a relatively low margin business if you are, only charging like 50 quid as an entry point. You have to acquire a huge number of those small ticket customers who will be your least valuable customers. Whereas, with our margin on our lowest investment amount, which is that 3 grand figure, which does seem a bit random, but that would cover, a 3 to 1 LTV to CAC. So, we would be able to acquire a customer, we would be able to onboard and manage that customer, pay for storage and insurance, and then ultimately acquire another customer. So we're optimizing that at the moment, but that was really the threshold where the business was sustainable because it helps no one if we go out of business ultimately. So that entry figure is a little bit strange, but yeah, it was the one that made the most sense. The really interesting experiment that we ran recently. So we launched a collection of Burgundian wine, and as your listeners may or may not be aware, Burgundy, in terms of price per bottle, is a lot more expensive than other regions because the producers produce great quality wine, but in vanishingly small quantities. And so it's the average price per bottle is more expensive. So we raised the average investment from 3,000 to 5,000 because we needed to hit a minimum size of the syndicate. And our average investment, which is around 10 grand, didn't change at all. So we get a lot of people coming in, who are investing the minimum, but I think cognitively, in the minds of investors, there isn't much of a difference between 3 and 5, whereas there is between 3 and 10 or 5 and 10. So it was interesting running these little experiments and basically saying that nothing changed because perceived wisdom would be people invest whatever the minimum is. And actually what we found is no, people keep wine as a static percentage of their total portfolio, which is a very different way of looking at things. I'm not sure that's groundbreaking stuff, but it was certainly very interesting from our perspective. Yeah, yeah. Yeah, I think there's we keep them in a bonded warehouse for good reason. But yeah, we always say to customers it is a little bit like getting high on your own supply if you're breaking into your investment portfolio. Yep, yep. Yeah, it's a really interesting one because so for the first 6 months it was just me, and then operations director Ollie Thorpe, from a previous employer, which is very naughty of me. And then obviously built out the data team in earnest, and we've just onboarded our head of investment, Matthew Small, and we are hiring for a head of growth at the moment, really to optimize those unit economics and to kind of drive top of funnel. Um, we've grown very fast revenue wise, so we're still in full hyper growth. We've grown 100% year on year. We're just coming up to our second year anniversary. It will be in October. and that's really encouraging. But I think the longer that I've been running it, and especially with that 1.5 million in the bank, I'm still quite cautious around spend. And, you know, onboarding this head of growth, what I really want them to be doing is, figuring out which channels are working, optimizing those channels, and then coming to me and saying, okay, this is the one that we should be spending on. And I think that's really been one, because we don't want to burn through customer cash. We want to build something super sustainable that can stand on its own feet, but also because we had so little budget in the early days. I think those habits have kind of stayed with us. So we do a huge amount of like LinkedIn activity, which much to the amusement of my friends who constantly mock me for my various kind of LinkedIn influencer type posts. But they're a great channel for us, and the whole team do them. Our head of data has really established himself as like a major thought leader within wine, because he's uncovering all these unique insights. And as a result, we get a lot of traffic from LinkedIn, but we actually get a lot of warm traffic as well, because people follow us on LinkedIn. They feel like they know us. They know that they can reach out on that channel, and it's more than just investing through like a faceless business. It's like, oh, I've been following Ollie, Aaron, Callum, Matt, Raf, whoever, for the last 6 months. Let's invest and see what it's all about. And that really came to fruition during our seed round. So we raised a percentage of it through Crowdcube, so as a crowd fund, and we had so many of our existing clients and existing LinkedIn audience come in, and that was a really, really amazing thing, actually, because getting the LinkedIn audience is obviously great, but actually having existing clients invest means a huge amount to you as a founder, because it's real validation. Well, it's validation in the strongest possible terms that they believe in what you're doing. So yeah, I think that my spending habits, to go back to your question, I have not yet. Yeah, they're very tightly on the reins when it comes to actually like spending that cash, until we have figured out a channel that is exponentially scalable for us. And then, as far as I'm concerned, we'll pile every penny into it until it stops working. The dream is to put £1 in and get £3 back. Wine drops. Yeah, yeah, he's amazing at content marketing as well. Um, his stuff really makes me laugh. And I mean, wine drops, I think, is such a fascinating business. And again, kind of goes back to, oh, young people aren't drinking wine. Yes, they are. It's a marketing issue that has to be solved, and I think wine drops are doing an incredible job solving that issue, because it's you know. Lots of the old and great wine merchants all look the same. They've all got the kind of like spidery gold text. They're selling to a certain graphic demographic, and actually, younger people buy in different ways. And what appeals to boomers won't appeal to Gen Xers, which won't appeal to millennials, which certainly won't appeal to Gen Z. And so I think that a company like Wine Drops, which is obviously great at the performance marketing side, but it just makes it so much, it brings it to life much more. And actually seeing Johnny, who's got, he's a young guy, he's got tattoos. It's a very different face to the one that would typically be there selling wine. So yeah, all power to them. I think they're a fantastic business. Yeah. Sure. So, two things. So, at the moment, we're going through a major round of development, and the reason that we're doing that is, one, to make the platform look a lot nicer, and more modern, more fintechy. But it's also so we can go global, so we can accept payments in different currencies. At the moment, we're GBP denominated, so anyone international that wants to invest has to convert it into pounds, which is a bit of an overhead. But it's also so we can integrate with third-party platforms. So, the ambition is you will go on your Hargreaves Lansdowne app, or you'll go on your, Revolut app, and there will be a Winefi investment product listed there under the alternatives or under the collectibles. And that way we can reach an enormous audience at scale. And I really think that we're in a unique position to be able to do that because of the syndicate structure. You can't do that if you're just selling a portfolio outright. And then I think the second thing is we are really, really focused on becoming a category defining brand. And what I mean by that is I really want to be synonymous with fine wine as an asset class. There are plenty of fantastic wine merchants if you're buying to drink. We want to be known as the go-to if you're just buying wine for anticipated financial return. And I think that in the finance space, if you think of if you work in finance and you think of an index fund, you immediately think of Vanguard. If you think of property, you think of Blackstone. If you think of art in the collectible space, you probably think of Masterworks. There is no like top of the dome type one for wine. And I think that vision is very, very exciting. And with it becomes, without sounding too holier than thou, with that vision comes a lot of responsibility. I'm painfully aware that fine wine is an unregulated asset class. And actually, we have to accept that if we are going to be the category leader, we need to have fiduciary standards in place that, that are the same effectively as any traditional investment business. So I'm very excited. I actually had a one-to-one with our head of data, Aaron, this morning, and he referred to the data model as his passion project. And that was an amazing thing to hear, because I do think that is the way that the team approach this challenge. We're building something exciting. We've captured a lot of attention. I would love to say it's because we're super amazing as a team, but I think it's also just because wine is fun and we're a new business in this space. So I think it's captured the attention of a lot of people. And now we've got shareholders. We need to deliver for those shareholders. So we want to get to scale, but we want to get to scale sustainably, and in a way that allows us to get in front of the largest possible audience at the lowest possible cost. We should, yeah, we should, we really should. Yeah, absolutely. I think on that occasion, yeah, we're allowed to do that. But no, Viresh, thank you so much for having me on. Really appreciate it.